Hi, welcome to Let's Talk Bonds, the weekly podcast from INR Bonds. I'm Arjun Patsati. And in this podcast, I'm going to talk to you about the significance of the narrowing of the spread between the 2-year gsec, which is a 2-year Indian government bond, and the 2-year US Treasury yield. Why has the spread narrow? And what is the significance of this? And what should bond investors and financial advisors advise their clients on bond investments and fixed income investments based on this narrowing of the spreads? And given this, the spread between the US Treasury and the 2-year gsec, which was 450 basis points or 4.5%. Okay, now what do you mean by spread? The spread is a difference between the yield at which the US Treasury, 2-year US Treasury is trading, and the yield at which the 2-year government bond is trading, 2-year gsec. And this spread was 4.5% last year. And now it's come down to just 2.5%. So just today, the government auctioned the 2-year gsec at 7.2%. And after a Fed rate hike on Wednesday, the US Treasury, 2-year US Treasury yield has gone up to 4.7%. So this is a spread of just 2.5%, or what in bond market terminology, we call it 250 basis points. So what is the main significance of this narrowing of the spread? Now, if you really look at what is technically called an interest rate arbitrage, and if traders want to just take advantage of the fact that the Indian rupee is declining in value, so what they can do is they can sell the rupee, they buy the dollar, and they can park it in US Treasury at 4.7%, 2-year US Treasury. And in last year, if they done the same thing, the differential at 4.5% would have been too high, and technical Indian rupee would have been a better yielding currency. But now at just 2.5%, the rupee may not be better yielding, clearly because of the fact that it is a depreciating currency. And this also gives rise to opportunities to traders to short the Indian rupee and then invest in US dollar deposits or even treasury yield, 2-year treasury yield, earning higher returns. So this can technically cause a sharper depreciation in the rupee. It can also mean one more fact that maybe the Indian macros are looking better than the US ones. The US inflation is at over 8% levels, and the Fed has, while raising rates very fast, is still behind on controlling inflation, and hence the very sharp rise in the 2-year US Treasury yield. As far as India goes, India's inflation has also been higher than RBI target of 6%, and RBI is not really raised rates as fast as the US Federal Reserve, and that is now limiting the rise in yields of the 2-year gsec. And but however, if that is the case, then the rupee should have benefited, because that means investors, global and domestic, are seeing that India is a better position to be in. But it's not really so, because the rupee is trending towards record lows. And then, so these are the two main factors that one needs to look at. Now, would this mean that the spreads can widen further? That means either or narrow further. If the Fed is still in US inflation rises much faster, and the Fed is forced to hike rates again by another 75 basis points the next, or even 50 basis points in the next 3 or 4 meetings, then the US Treasury yields can go higher. And if RBI does not follow suit, then the spread can narrow. But having said that, if the spread narrows, then there will be more appetite for traders to sell the rupee and buy dollars and park it in US Treasuries and take advantage of a depreciating rupee. So maybe RBI has to hike rates faster and that could potentially take up the gsec yield as well. So in this scenario, what should investors do? Clearly, there's a lot of uncertainty going forward, given the spread, narrowing of the spread differentials. Hence, it's best to be safer. Check for visibility of returns. I would say the best investment duration should be not more than 2 years. And there are very decent, if you can get decent returns, given that short-term rates are high, and then park the money for 1 to 2 years investments in bonds, and take the whatever the returns available. And once the market stabilize, better to look at longer term options if required, or any other options to take advantage of either falling interest rates or stable interest rates at higher levels. And our bonds is obviously the best place for financial advisors to advise on for investing in bonds for their clients' portfolios. We have a list of over 200, 150 plus bonds where live quotes are available, so giving you the most transparency in prices. And of that, we even curate bonds if advisors require or investors require a curated list. And this is available with our own proprietary risk score, which gives you the best information, and you can take your own risk adjusted investment preferences. Thank you very much for listening in to this podcast, and do follow us on all podcast channels.